Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. Welcome back to the Loonie Hour, episode 14. As always, joined by the three amigos. We've got back in Canada, Portugal's finest farmer, the Tom Brady of macro, Rich Diaz with Acorn Macro Research. He has now left his school prison cell. And of course, Keith Dicker, everyone's favorite boomer. Welcome back, gentlemen.
Yo, yo, yo.
Hello. Hello. That's Acorn Macro Consulting, just for the record.
Yes, Acorn Macro Consulting. I actually, Rich has been sending me his letters. So they're very, very good. Highly encourage you to subscribe. Free plug. There you go. But yeah, we'll kind of kick things off here. Not to beat a dead horse, but we did get a U.S. CPI print, 7%, a couple days ago. So, not highest since 1982, 40-year high. So obviously that's making the headlines, which kind of coincides with the hawkish Fed coming out and saying, I think I was reading this morning, it was like one of the big banks. I don't know if it was JP Morgan or something, but they were calling for 25 basis points, a Fed hike essentially every single quarter from now until the end of 2023. So I'm sure we'll probably get into that on the show, but that's kind of where sentiment's at right now. We basically got this, inflation running hot. Oops, it turns out maybe it wasn't transitory, and so now everybody thinks the Fed is going to do the right thing, which is to hike rates and squash inflation and try to be Paul Volcker when global debt to GDP is 365%. So, Keith, I don't know, any opening thoughts there?
Yeah, it's just so people realize, how, I don't know if it was JP Morgan or Morgan Stanley actually that came out with that one. But so you sort of work backwards. Say they believe the Fed should get up to 3% as an example. You just start counting backwards, because the only time a central bank will make a move greater than 25 basis points or greater than 0.25% is unless there's an absolute crisis or emergency taking place. So think back to, again, I think it was March of 2020, Bank of Canada came out one morning and they did 50 basis points. I don't know if you guys remember that. It was and it was in between meetings as well, right? So the reason I share this because—
When was this? The early 1900s?
Yeah. It's not quite that far. But the point is, unless there's a crisis or a meeting of some sort, central banks, they can only do their job when they have their assigned meeting. All their scheduled meetings are set way in advance, so they never deviate from it unless there's a crisis. And so for them to start, getting rates from basically, 0% now up to 2% as an example, or 2.25%, they need 8 meetings to do that. So that's how you sort of start counting how many meetings they need and how long it'll take them to get to that certain point. I think, I know we've talked about it before. I don't know if you guys will agree or not, but I don't think they'll get that far with it. They might get, 3 or 4 rate hikes put in before, if things get a little bit wobbly out there. But that's what I suspect. And with that CPI print yesterday morning, was it 7% on the headline number? I think it was.
Rich is gonna unpack it for us too in a minute here, but
so 7 year over year. I mean, so let's just say inflation will stay at 7% forever. That's where it wants to be. The central banks have to raise rates to at least 7%. I mean, that's where they just to make it like sort of an even trade out there, for the market. And so just think you had to raise 700 divided by how many years are we looking at there, Rich? Rich is the smart guy with the glasses.
God, no! I'm terrible at arithmetic. Please don't put me on the spot there.
I'm not good with that either. Like you manage money and you can't add sometimes.
I cannot do arithmetic.
Isn't that 7? Isn't it 7 years?
It would be
14.
Yeah, absolutely. 7 years, maybe 6 because you get a couple extra meetings poked in there. But that's the main story about this. So whenever a central bank will make a move, it's always 0.25%. Unless it's an emergency. And if it's an emergency, it could take place at any time. But that's very rare for that to happen. How about you, Rich? What did you
And
see?
let's be clear, this is not an emergency, at least not yet, by the sounds of it. But
No.
Rich.
Well, no, just to add to that, it's only in an emergency if financial markets are telling you it's an emergency. And right now, the stock market is not falling, currencies are not crashing, the bond market, like nothing is forcing the central bankers to do anything. Now, mind you, we talked about last week, that the bond traders had to wake up from their slumber all of a sudden, and they don't like that. But the bond market has slowed down a little bit over the last couple of trading days. So they're probably back asleep again now. So that's good for you don't want bond guys to be awake too much, guys. You don't want that. You want them to stay steady, caffeinated.
That's when people get upset.
Rested.
That's where we draw the line.
You don't want to tick off a bond guy. It's actually you do, because it's kind of funny. They have a very irrational response to things. I've seen it before. It's fun. I like poking those guys. Anyway, I got a few stories about that, but another time for that.
Oh God.
Well, for me, I mean, if I'm going to just kick off on the inflation thing, I think just a couple of points that I thought, I mean, there's some great people on Twitter who like really break down the inflation. And the more I read them, the more I feel inadequate. And so I'm just it was 7% as we talked about. Core was 5.5. I think soon we're going to have the Canadian number out, I imagine. So that'll be really interesting. The thing that I think the two takeaways I had were, one, the shelter component, which we've talked about a lot before here, just continues to creep higher. Shelter is 38 or 42 or whatever it is, a lion's share of the CPI basket. And one of the main reasons why I don't think it's transitory, because there's no supply, there's no vacancy in the housing market in the United States. And so, and this is based off rent, and I'm sure someone in the comments will tell me I got it wrong. But anyways, the point is the shelter component is continuing to tick higher and higher and higher, and now contributing a significant amount of the CPI. So for example, I think over the next 6 months or, whatever, I think you'll eventually, you're starting to get the year-on-year comparables. So it's very, very hard. There's certain, people talk about base effects on the down leg. And then, people say, 7%. Yeah, because prices were down, but now you're starting to get the base effects on the rise up. And so it's going to be very, very hard, obviously, to get higher than 7%. And I think that the next 2 months, I think you're in sort of this like another sweet spot. I think you might have inflation tick a little bit higher, but once you get into the April, May, June, the comparables are extremely difficult. And so I think you're going to have a reignition of this debate about whether it's transitory or not, because inflation will naturally start to come off. And so that's sort of, for me, that's like another main takeaway. So shelter, the base effect is the second takeaway. And the third takeaway is the used cars and durable goods. So used cars and trucks were up 37%. It's a similar situation in Canada where you have an enormous increase in used cars. That's, I think, a very acutely a supply chain issue with respect to semiconductors. And obviously China is one of the largest car manufacturers in the world. And Germany, you can see Germany's industrial production keeps falling because they don't produce any cars anymore because of the semiconductors. And then the durable goods, which is the last point, that's also like 17% or whatever the number is. I think that's a structural change. We've talked about this here before. I think the Chinese deflation story is over. So going forward, that's something I'm really, really paying attention to, the durable goods number, and whether or not, I don't, obviously it's not going to keep rising at 17%, but for me, it's about whether or not for years and years and years, that number was negative. And so for me, I don't care whether it's 17 or 10 or whatever. It's just, are we now in a structural positive? Are we all going to stay above zero for a sustained amount of time? And then the final thing for me, as far as the CPI print, which was just that, the market actually, funnily enough, the market didn't react. I don't know, Keith, if you have a different view on this, but I thought the market was actually quite boring given that we're at a 40-year high in inflation, I think the dollar actually sold off. Bond yields didn't really do that much. The equity market was kind of went meh. And I think it's kind of I think the market in many ways is sort of finally has their head wrapped around this phenomena in a way that I don't think was true 6 months ago. So I don't know if you guys have any.
I mean, one comment with that, currencies had a really big move yesterday. So the dollar sold off pretty hard on this news. And, with hindsight, the market would always try to figure out, okay, why did it do this? And then they come up with a reason for it and whatever. And so so the headline story would be, inflation wasn't strong enough because it was in line with expectations. It wasn't a crazy number. For the average person listening and watching, they'll say, wow, man, 7% is a big number. However, the market was expecting that number. So therefore, because there wasn't a surprise to the system or a shock to the number that came out, markets adjusted. But other thing as well, that the dollar has just been ripping higher over the last number of weeks. So, from a, so in the investment world, you're able to determine if people are hedge funds are net short or long a market. So you use it as a contrarian indicator. So if everybody loves one thing, like picture a boat, if everyone's on one side of the boat, it's almost tipping over. And what do you want to do? You run to the other side, and then people, run back again. So, a lot of this was just profit taking in the dollar. So the opportunity is here again now, for the dollar to start, getting its footing going higher. But I have a thing that we can talk about as well. Unless you want to talk about the CPI first.
Well, yeah, I mean, just even from like, I don't know, just even from like a, housing perspective. I think we chatted about this like last week, but I put that, video up on Twitter. But like, I don't know, I just see this like, 7% inflation. I mean, Canada, I guess it's slightly lower, even though I'd argue it's probably not the best indicator of real life inflation. But I know, Rich, you were talking about like used cars, and those are making up a huge component, and obviously rents as well, in the homeowners equivalent in the CPI basket there. And like, to me, like that plays right into housing, because like, okay, how much of this used car component is like, well, we do have like everybody seems to be shifting further away from the cores into the suburbs, and nobody wants to take public transportation. So everybody's out there buying, vehicles and whatnot. So that plays a component. And number two, like basically what I'm seeing in the housing market is just like in Vancouver here, and hearing stories anecdotally across Canada. It's utter insanity. To what I'm seeing, like from a, boots on the ground perspective. I mean, I was at a couple open houses on the weekend. You've got lineups around the corners. You got people like 20 minutes just to get in to see a house. And these are like very average entry level suburban houses, which in Vancouver now, that's like $1.5 million. And yeah, it's just, people are just leveraging up. Banks are handing them this cheap credit. And we're seeing, rents, the rental market is just absolutely on fire. And that has not come through at all in any of Canada's CPI data. So I'm kind of like, man, like, yeah, transitory. Like I'm having a tough time, because I just keep seeing more anecdotal signs in the housing market. I've got friends texting me saying, lawyers in Vancouver are going to get huge rages this year. He's already seeing it because he's in those front lines, and it just kind of seems to be permeating through. And I think, I know, Rich, you've been kind of advocating for rate hikes. Like, I think we need them. Like this housing market's out of control, and I'm kind of worried that something's going to blow.
So the rate hikes are coming, guys. So it's no longer a question of if. I mean, they're coming up. So Bank of Canada is up this month now. I think they're next week. Right now it's 50-50 whether they hike in the next meeting. So this story is starting to play out exactly the way that we've been expecting it will. And the initial shock will be higher rates, and we'll see where we move along, from this side of it. I do have a question for you though, Steve.
Sorry.
Sorry, Rich. Another question about. So I've never been involved in a housing market, so to speak. In terms of trying to buy or sell. I've done it once. It was a very muted. However, it was an interesting situation in that the people that were selling it, they were going through a bit of a nasty divorce. So there were like 3 parties negotiating, and
Keith the Shark.
well, I know it was horrible, right? Because I'm like, who am I speaking with here? However, why don't you share with everyone who has not been involved with an open house with like that, and obviously COVID is involved, but like, are there 50 people running around a house? Are there 2 people at a time? And the energy must be unbelievable, especially if you're the seller, I would imagine.
Yeah, it's like there's like, so I went to like a couple in the suburbs, when I went to in this weekend was like, I went to like the hottest sort of segment of the market, which is like entry level house in the suburbs, which everybody wants, nobody can afford, so everyone's squeezing these price points. So like basically what's happening is like, because of COVID, they usually only allow like 2, maybe 3 groups into a house at one time. And so you have to like, they're trying to like get people like ideally like book appointments, but like all the appointments are filling up for the entire day. So now realtors are basically just saying, you know what, just show up. We'll get you in when we get you in. So now people are basically like lining up around the block with their masks on outside, waiting to get into the house. And like all these houses, like the one that I posted there on Twitter with the video, around the corner, the guy had underpriced it, but he ended up with 41 offers, $400,000 over the asking price. Another one I went through, like the house was literally leaning, like the foundation, like I went to the kitchen, I almost fell over because like the foundation was.
Sorry, Rich. I'm sorry, Steve. A question: Would somebody make an offer on the spot? Like, again, I don't know the mechanics.
So they're holding people off. So what they do is they like a listing will come on like say Monday or Tuesday, and they'll say, hey, listen, we're going to push everybody through this week. You come through the showing, and we'll take offers the following Tuesday at 4 p.m. So if you got an offer, email it over to us, by Tuesday at 4, and we're going to pick basically, the highest, cleanest offer here. Mm-hmm. And so, okay. But I always make the joke, right? I mean, like, man, like if you got to beat 41 people to get a house, like, do you really want to be the guy that wins the bid? Because like, what kind of price are you paying if you have to beat 40 other people? And that's just what we're seeing. Like, it's unbelievable. I think it's totally out of control. And it kind of brings me to my next point, and I'm sure you guys have some comments on this, Rich, maybe from a data perspective. But one of the things I've been talking about with regulators and having these conversations, because I think something is coming. CMHC is now talking about increasing the down payment requirements for investors. They're trying to put the brakes on. So what's interesting is you've got RBC's CEO coming out and say Bank of Canada needs to hike rates. Inflation is out of control. These guys want to pull back on lending in the residential mortgage market, but they can't because they don't want to lose market share. And so you have what you have now is you have all these public CEOs coming out and making public statements and saying, oh, the Bank of Canada needs to and should be raising interest rates, because they want the Bank of Canada to be the brake on the housing market, not them individually.
That's their job. That's the Bank of Canada's job. They're derelict in their duty. Then they're, in some ways, those CEOs are right. It's not a private corporation's job to be the super, to be the regulator of the housing market, or it's in my view, that's exactly right. They should be. And you know what? I actually credit these guys, frankly, for putting pressure on the Bank of Canada, because the reality is the politicians in this country pretend like they don't understand why this is happening.
Inside information.
Know why. We know why.
There's been a couple of the banks, can't say who it was, but there's been a couple of the banks that have actually lobbed the federal government to put in a home equity tax, because again, they want to slow the housing market, and that did get kiboshed. They basically came back and said, no, we're not doing that from a political standpoint. But the banks have been pushing back, even though I'd argue that they are certainly part of the problem in the fact that they're the ones that, write these loans and make all these exceptions to get them approved. But that kind of brings me to my next point, which is when I have these discussions with these policymakers, news reporters, etc., one of the things I'm always kind of like, well, like what can we do in the very short near term, let's say in the next 12 to 18 months, if we want to put like a temporary like brake pad on the housing market? Do we look at these immigration targets? Do I say like we had 410,000 people approved as new immigrants last year? I mean, the US, a country 10 times the size, had 500,000. So my question is always like, why is the federal government so hell-bent on 400,000 per year and ratcheting that up? Should it not be for the next 12 to 18 to 24 months? Maybe we ratchet that down to 350,000.
I thought we were in a pandemic. I thought there was like a global supply chain problem. I thought we had to get boosters, or else you can't go watch, Spider-Man Return to Home or whatever. I mean, the idea that, I don't know. I'm going to get myself into trouble here, so I'll pump the brakes a bit. But I think, yes, Steve, I think perhaps lowering the population growth numbers and immigration numbers, maybe for, how about this, 2 years, until we sort of get built homes being built again, and et cetera, et cetera. I mean, generally Canada accepting immigrants is a good thing. I think that's unequivocal. However, you need to be able to house them. You need to have appropriate infrastructure. You need to have schools and libraries and et cetera, to make that a transition that does not cause political or economic friction. And for the government, whichever government, to just to ignore the effects of that, I think is just plain stupid in my view.
Yeah, no, I mean, Keith, do you have any comments on like, because like I think the listeners here, for example, are gonna want to like why, in your opinion, is the government so hell bent on like, oh, we got to hit this target? Why do we need to, like, what can you explain that to kind of the audience? Like, what's the government's, in your opinion, what is the government's kind of thought process behind that? Is it simply to fill jobs, to get highly skilled immigrant workers in, or is the goal to inflate nominal GDP and boost tax revenues because you're a government that's short on tax revenues essentially?
I don't think it's the latter. I mean, remember, guys, governments are pretty big entities. One arm doesn't speak with the other. It's really, they don't have this, this centralized, group committee that's, pulling the levers for everything in the country. The sharpest companies in the world can't even work like that. I know with Canada, you're always encouraging immigration, and there's lots of positives with it, absolutely, because a lot of new people coming to the country, they're highly motivated, they're already educated usually and skilled, and it just helps to broaden the economy and the culture and all that stuff. Like there's so many benefits attached to it, and it's been really good. As for them deciding, hey, it's also a great way to raise GDP, or hey, maybe we should think about the housing market, I don't think that hits their desk at all. I really don't. I think they would just say, you know what, that's past our pay grade. That's what the Minister of Finance needs to think about, and the Bank of Canada. So that's the way I see you. Again, like I really wouldn't give these guys that much credit in terms of trying to be devious about trying to boost the economy and affect housing markets and stuff. That's what I think anyway.
Well, they do talk.
Sorry, Keith. Okay, go ahead. Sorry.
Well, they do talk about, you hear them in this BS House of Commons, whatever, going back and forth. They do talk about, well, GDP is back to, above pre-pandemic levels. It's like, well, this nominal GDP, right? Like if you, again, adjust for inflation, whatever. So like, but the big thing too is like, well, we unpack that further, Rich, real GDP per capita, which is really a measure on like, are we as an individual one-to-one actually getting better and growing and being more prosperous? No, it's been flat for 5 years. So again, I don't know, Rich, what were you going to say?
I just want to say I agree with Keith's point in the sense, but I'm going to put a finer edge on, is that they're not that smart. I concede that, but I think there's also a sense of, I think that there's a cowardice, because I think the idea that the current government is not aware of the severe housing crisis that we are having in this country, that is now into its 6th or 7th month at least of like on CBC News, CTV, constant stories of lineups around the block for people who are searching for that, the idea that they don't know a lever to adjust that, to me is not true. I think they know exactly how to do it. I think that there's a certain cowardice. They're need to be seen as like a welcoming group, and unfortunately they're unwilling to make the hard choices with respect to how to adjust that. And I think you hit the nail on the head. I mean, the way I wrote down a little note, there's population growth, which is at 35-40 year high almost exclusively as a result of immigration. You can adjust that. It takes very little effort to do that. There's supply, which I think is a little bit more difficult to adjust, but I think eventually as COVID relaxes itself and the summer kicks off and people start to get back to work, and fine. And then there's interest rates, which we know the central bank has compromised its independence and is unwilling to adjust those. So 2 of the 3 levers with respect to the housing market are, in my view, you're absolutely able to adjust those in a responsible, effective manner with the desired outcome that I think is good for everybody. But in my view, that there's a certain amount of cowardice. There's unwilling to make the difficult decision, make the tough choice, and largely for political expediency, in my view. And I think to let them off the hook, I think is wrong.
Maybe I'm still young and naive. I just thought that they would have been smarter and there was some sort of grand master plan here, but clearly you guys aren't in that sort of thought process. So it is fascinating, but I mean, Keith, I don't know if you have any sort of final thoughts on that, but
no, Keith is kind of multitasking, guys. I apologize. I'm actually I'm doing a trade as we sort of talk about how I'm not buying or selling a house either.
Yeah,
let me just make one. Then while Keith's talking, I'm going to step in and just make another point. I think what's also sort of really, I think one of the things that immigration sort of does do is it actually, in some screwed up way, it sort of mitigates the negative from a housing crash. Mm-hmm. And because you think of one of the reasons the housing bubble bursting in Spain was so bad was because the Spanish people left. Yeah. Right. So once the housing became so insanely overpriced relative to their income, relative to rent, Spanish people just went in droves to London, or they went to France, or they went to Germany to work and to take advantage. You can see the population number in Spain actually just literally stopped growing after the housing bubble.
Yeah, was that so? My question now is that wasn't, because I did some research on that, and I'm certainly not the expert, but my understanding was the outflows, similar to Ireland, the outflows happened once the housing bubble burst, because it burst, the economy went into the dumps, people lost jobs, there were no jobs, and so people left in search of jobs and more
right
opportunity elsewhere because there was nothing. The economy was decimated.
Yeah, that's right.
I think Spain has the largest.
Yeah. I'm back again now. Sorry about that. But one thing that's this is what's going to happen here. Governments are never proactive with everything. They're always reactive. That's the way they're built. That's the way they're structured. When you run for office, it's always to fix something that some other guy made a mistake with. You're never going to say, hey, you know what? In the future, we're going to have a real hard time. I don't know, whatever you want to come up with. So then no one's going to vote for you for doing that. So what's going to happen now, for the first time in a lot of people's lives in Canada, like we're all experiencing this severe housing market, and everyone in elected office, no matter which level, they're hearing about it. Everyone is hearing about it, but they don't know what to do about it yet. So when the next round of elections come up, and when people are in position to, when politicians or policymakers are in position to do something, they will be doing something. and then we'll figure out with hindsight, or I can tell you right now, they're going to be very slow in doing it, and it's going to be in response to the past. And of course, the future is going to be looking a lot different. So that's where we're going to be headed. So we're going to end up seeing some crazy new tax or transaction fee on something, and it was created during the time when Canada had the big housing bubble, and so that's what we're headed towards.
Speaking of the future, we've talked about this before, but I noticed that Visa came out yesterday and said that they're in spring they're launching their test for their central bank digital currency payment rails this spring. So they've teamed up with a couple central banks to start working on their central bank digital currency. So we've chatted about that on the show before, but that seems like it's coming to life a lot faster than anybody anticipated.
That's going to be huge when it comes. I mean, we'll have another really good chat about it, down the road here as we get closer. But for everyone to know, the Bank of Canada has been one of the early adapters of this. They have a lot of papers on it on their website. You just got to go in and find it. And then they have some sort of like loose, moderate type conversations about it and in pressers and stuff. But dig into the website and you'll understand very quickly that when the Western world moves to a central bank digital currency, and it'll happen all at the same time, the Canadians will be right on board. They're going to be there to have a good go at it.
Listeners should be very afraid. This is not a good thing, in my view. We already have a digital currency. Have you ever seen any of the money that you nominally own? I mean, Keith's worth billions. Have you ever seen any of it? It's already digital. It's already in a computer somewhere on a ledger. And what this, in my view, what this so-called digital currency means is that you have complete control from a government entity, and they can wipe out that ledger in a minute. And I think that's for me a very, very, very scary thing.
Yeah, I think just a lot of people may not quite understand what we're talking about. So right now in Canada and a lot of places around the world, we have electronic currencies. So like I have I have one of these things on my desk. You guys see it?
Yeah.
Yes,
piggy bank.
It's up here. Here it is. It's
Guinness piggy bank. It says beer money. Okay. Yeah.
Yeah, and here it is. I'm just thinking about Guinness now. I lost my train of thought. But in Canada and a lot of other places, we don't use physical money anymore. Do you have a tenner in your pocket right now? I don't know if you do or not, but most people don't. I just use my phone all the time for everything. But that's electronic currencies and transactions. They're still flowing through our commercial bank systems that we have in place. When we talk about a central bank digital currency, what it means is that in many ways, the commercial banks will be replaced by the central bank. And there's a very big difference with this when it happens. So instead of putting money on deposit with your favorite big six bank, and you put it on deposit with the Bank of Canada instead. And the average person say, well, who cares? What's the difference with doing that? By doing that, you eliminate any credit risk with your bank from going under or having a bank run. And of course, this is where Canadians say, well, that will never happen in Canada. Canada has the bastion of great banks and all that stuff. However, these are things that central banks are talking about all around the world, especially in Europe. In Europe, they are frightened to death of the bank run happening. But by going with, this is just one of the benefits by doing this. And it will create some pretty big movements. So you can find papers online, Bank of Canada website, and they specifically, they talk about this. They don't talk about bank runs, of course, but they talk about, they will be able to offer deposits, but they will not be competing directly with the commercial banks. And of course, then the smart person is going to say, well, wait a second, you are competing with a commercial bank the moment you do this. And the commercial banks, they've commented on it. No, we know we can all work together and everything. But if you're a Canadian bank, you have zero competition for stuff. and this is again, they're rolling their eyes. No, that's not true. We have lots of competition. They're all moving at the same time, the same market with rates. All of a sudden, you have this enormous player who does not have to raise any capital. They have no shareholders to answer to. They don't really have a boss. And this is where they'll start pulling the levers again to really try to influence, who can do, this or that. And at an extreme level, you might hear some of these stories where, they're going to be able to tax you on different purchases. So
that's what I wanted to say.
That's the extreme stuff. So Rich, why don't you give us a story about that, like how that would work?
I just think what I understand is, so first of all, I think the choice to make, so when it comes to this kind of stuff, I'm probably staunchly on one side of this. I'll let you guys figure it out. But to me, the power to vote with your dollar, the power to choose what you want to do with the hard-earned money that you make, unencumbered by a political process, to me is the core of democratic principle. And what I can see coming down the pipe, which is to me extremely obvious, is a government can decide a particular thing is not desirable. Let's say spending money on gasoline. And then given that they have 100% control on the particular currency, they can bar you from making a transaction with a particular organization that sells, let's say, petrol or gasoline. That's one way. They can, if buying marijuana or alcohol after a certain time is undesirable, you can do that. You can execute that plan because that's what the technology offers you. If you and it also, so that's the first thing. The second thing I think is really important is that same technology can offer you the ability to adjust interest rates and deposit rates. The amount that so how much money you would have to pay on a particular loan, or how much money you receive on a particular deposit based on who you are as a person and your overall situation, education, race, religion. I mean, that's maybe an extreme situation, but we've already seen sort of examples similar to this. Hiring based on what your ethnicity is. Why wouldn't you receive an interest rate based on your ethnicity, or a return on your deposit? To me, that's a natural extension of that. So you guys might say I'm crazy, and that's fine. But I think that the real issue is ultimately you're again gumming the works of what is a natural flowing process.
Yeah, I mean, this is it like China's already got this, which is like the Chinese credit score system. They've just released.
Didn't even thought.
They've just released the digital yuan, which apparently there's like an app apparently in the Chinese app store you got to download. They're trying to they're rolling it out for the Olympics coming up here, but apparently it's the most downloaded app in China right now. So like they've kind of unrolled this program, but they've already got this social credit scoring system, and so the idea is that social credit scoring system will sort of intervene or chat with the digital yuan. So again, based on how good of a citizen you are, if you obey their lockdowns, for example, you'll get incentivized perhaps financially, right? Maybe that's a higher interest rate on your holdings there, something along those lines. So I don't know, it's kind of a slippery slope. I mean, it seems like we're kind of going down that path. But this is probably another conversation for another day in terms of this whole ecosystem, because at least in my view, that's why I'm like super bullish on the sort of cryptocurrency space in terms of because for example, these central bank digital currencies, whether that be in Canada, the Eurozone, I know for sure, has already partnered with Ethereum will be the settlement layer. So this information basically also has to go onto the blockchain. And so that will basically be used and stored using Ethereum blocks essentially. We know we've had the Fed out recently, I think, talking about several central banks talking about that they believe private stable coins will be able to coexist with central bank, stable coins essentially. So again, that could just be a complete baloney, but this whole system is kind of interwoven. And I think that all ties in. There's going to be many winners, many losers. But the financial monetary sort of payment system as we know it is changing, and it's going to change drastically over the next 5 years.
Can I just add one thing? And I know we're going to switch gears here, but I think what's important to ask yourself is why this is now becoming desirable from the perspective of a central bank. Why, given what's been going on, you have to ask yourself, why do they care about this? Why do they want this? And I think, to me, it's the idea that for the first time, basically ever, you have an alternative, and the alternative is the private coin. And I think that that should scare central bankers to their core. And I think that they're doing, and that's why you're getting this reaction. I don't think so if the reaction is not we think this will make the world better, so we're doing this, the reaction is we're under threat and we're doing this. And so I think that's, for me, that's why I'm so kind of anti this. And I'm super, super skeptical, because they've pooched it, right? It's clear, right? You don't buy 90% of debt issuance if your financial system is happy. And I think that Bitcoin or other such similar technologies offers consumers, people, citizens a way of extracting themselves. And that's a threat. It's a threat.
Can I just chime in quickly as well? That you can see that they're all trying to kind of like figure it out, and like, what do we do? Do we ban it? Do we not? Like, so we had like, China's obviously like banned it, but like there was a story out, I think it was today. It was like India technically banned like cryptocurrency, like Bitcoin was banned in India. Now they've brought it back in and said, okay, it's actually okay. And now they're launching a Bitcoin ETF in India. So it's like, you can see they're kind of grasping with like, okay, what do we do? Do we just outright ban it? But if these other countries don't ban it, they might be further ahead. It's kind of a cluster. So
see, I don't. So over in India, for example, I'm just going to make a wild guess here, and I'm pretty confident I'm right. When they said, hey, we're going to ban this, all of a sudden they got a tap on the shoulder from a few guys with a lot of money. And all of a sudden they come out on Monday morning, say, you know what, we changed our mind. We're not going to allow this to happen. And so I think that's what's happening in India. But, just to sort of circle this all up here together, the reason we're talking about central bank digital currencies and, some form of crypto taking place here, social credit scores, all these things that if you haven't heard of these stories before, you're thinking, this is insane. This is crazy. These guys are nuts. We know Rich is because, his background traveling around and everything. But the point is, just remind everyone, we are at the end of this, 60-year cycle of interest rates. They've hit the ground floor. They're at zero and negative. Everyone's borrowed way too much money. Things are going to change. It is coming. Don't be afraid of it, because it's happening, and you get a great opportunity to make some money on it. But the way you do that, though, is to understand why it's happening and where you should, deep to the left and right, and go from there.
We're gonna yeah, thanks for this conversation. We're gonna end up on CBC's hit list for 2022. I don't know if you guys read that article, but someone sent it to me. So CBC, not to dump on CBC, but it's too easy. Well, they wrote a top 10 list of
non-desirables,
non-desirable things that they never want to see again moving into 2022. So it was like a year end for 2021, and it was like the top 3 things on that list was like, I never want to hear or think about or talk about NFTs again, like what a scam. And like, granted, yes, there's a lot of nonsense there, but they're going to be around in 10 years, and they're going to play a very large part of society. Number one. Number two, I think it was like Joe Rogan, who they're like, this guy is an idiot, blah, 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 blah. Meanwhile, he's the most streamed personality today ever, like on record. So I don't know. It was just, yeah. Anyways, so we're probably going to end up there next year. Number one, never want to hear Keith Dicker on the Loonie Hour again.
Can I ask you a
Loonie
question,
Hour.
Steve? Were lockdowns and COVID on the list of things we don't want in 2022?
No, those are things that we want more of in 2022.
Okay.
Yeah. So anyways, I don't know if that's my thoughts. You're going to end up on the,
You're in good company. You're in good company, I think.
It reminded me of that Big Short quote. Truth is like poetry, and most people hate poetry. Yeah. What else are we looking at here, though? I mean, I think that
I've one I can throw. I think energy. I think the energy space is really, really interesting. So the best performing sector this year. I mean, it's only been like 7 or 6 whatever trading days. So, I know, big grain of salt here, but I think Brent crude oil smashing through 87. Inventories are.
Do you have like a price target on that?
Oh, I always cop out whenever anyone asks me for a forecast or a price target. I always say I don't make them, and I think people get married to them. I think you get philosophically attached and anchored to a particular number, and then when you're wrong or you're right, you refuse to adjust your view. I think what's more interesting for me is that energy companies have free cash flow yields of 20, 30, 40, 50%, and we discussed this in our end of year podcast last year, but I think the climate change thing has made a lot of these energy companies massively profitable.
Which kind of reminds me, because there was actually an article today here in BC, gas hit an all-time record high. So the CTV News picked it up and made headlines. Metro Vancouver gas pump prices were $176.9 per liter. Yeah, certainly. It's funny because I had there was like a group of people on the internet here. They were like complaining. There's a big long thread, and I was reading the comments just for like entertainment purposes. But they were like, "Yeah, inflation's out of control, and look at gas prices. It's these government needs to come in and regulate these oil and gas companies. They're gouging people." And I was like, "Oh man, this guy needs to listen to the Loonie Hour." But because I think it's like governments again have kind of brought a lot of this on themselves, right? By discouraging investment in the oil and gas space, you create these structural longer term supply crunches, right? And then obviously carbon taxes is certainly contributes to higher prices at the pump. So like you can't have your cake and eat it too. What else? I mean, lumber prices are back on the climb. I was chatting with one of my friends. They're big developers in Calgary and Vancouver. So they build a lot of condos. They've been around for 50 plus years. But he was telling me they were looking at like a project more recently in Calgary. They had tied up the site and they're running their due diligence, and they're like, okay, let's price this thing out to see, like, do we tie this project up for the right amount? And he was like, yeah, since our last project, I think he was saying they completed it in 2019 or early 2020, that their construction costs were up between 30 to 40%. He's like, anyway, I was like, oh, was it like just like lumber? Like what do you see? And he's like, it's like everything. He's like, windows are way up, PEX piping for the water pipes, obviously lumber price. He's like, everything is up, and it's one of those ones where he's like, either we're going to try to pass this through to the end consumer, or we're going to have to drop the site. So
that's one of the things I'm looking. So I'm writing my note for this, my asset allocation strategy note. And one of the things, that we think about a lot is to what degree consumers in Canada, in the US, in Europe can absorb these inflation numbers. So one of the things that we forgot to mention is the 7.1 or whatever it is. That's the stated number. I think anecdotally, we would probably all agree that it's probably significantly higher than 7. Just like when it was 2, I think we said the same thing. It was probably way, way higher than 2. And we were kind of incredulous at how this number is so low. And I mean, even my mother knows that, food prices are up, 30 or 40% or whatever it is. And so for me, one of the big risks that I look at, so even though I'm quite positive on risk assets, I've said that before, I continue to be, and we've discussed why I don't necessarily like bonds. But the thing is, for me, one of the big risks is how, you can't raise prices indefinitely, and there is a limit. There is a point where consumers and businesses eventually squawk. They turn off that willingness to consume, that ability to absorb that price increase, and obviously that eventually leads to the ability for companies to maintain their margins, which are at highs right now, and then margins obviously lead to EPS growth, earnings per share growth. And so for me, that's one of the really kind of key things that I'm looking at. And so far, so good. You have wages are going up in nominal terms. It's my view that people do not look at real wages. Happy to have an argument with that about somebody online. And the second thing is their house, which is, Canadians, I think it's owner occupier rates in Canada and the US are 60 plus.
69
in
Canada.
Yeah, exactly. So your most important assets rising, so you feel wealthier. So that's two. And then you can see credit card spending in the US and Canada and UK and Europe is starting to rise again. And so you got three things that can kind of push this ability to absorb higher prices going in the right direction, let's say. But what if the thing that dominates my thinking, and I'd love to hear your guys' view on this, is number one, do you think that that's sustainable? Number two, am I wrong in the way I've characterized that? And number three, do you see any other things on the radar that could crash that out? Because I think for me, that's basically that dominates all of my thinking at this point.
I'll answer that. It's no, and yes.
Wait, I forgot the questions.
No, and yes. I forget to order the questions as well. So here's what again, this is from a market perspective. I suspect in, let's just say 6 months from now, all this talk about inflation and rising price, it's going to be waning. It's going to be coming off. It's going to be coming off. So the main reason for that is that we just had like this enormous global economic shutdown, and then never before seen stimulus thrown on top of it. So both monetary stimulus from central banks, through like money printing, if you want to call it that, as well as with lower interest rates, negative rates, and all this stimulus from governments. And that's in return, that's resulted in this catapulting economic reaction. So everything's been going sky high to the moon. Every single time we've had this, like even ignoring all the stimulus, whenever you get this rapid recovery from a sort of a rapid slowdown in economic activity, it always comes crashing back down again. So we're going to, even though GDP numbers are pretty high right now, remember they're always in the past or with hindsight, same with the inflation data that's coming through. In our mind, it's highly likely now we're going to be coming to a period with more muted growth, economic growth. One of the key indicators that we look is growth in central bank balance sheets. Ed Yardeni has great information on that. So Ed Yardeni, if you guys know his name or not, it's all free on his website. Ed's been putting out this great information for a long time now. But you can see there's one chart in there that shows, maybe we can share this one on the podcast with everyone, but it shows the growth in central bank balance sheets on an aggregate level. Actually, no, it's for the big three, so the Americans, the Japanese, and the Europeans, and it's now coming crashing down. If you overlay on top of that equity markets, you're seeing, wow, okay, yeah, things are going to start coming back down again here, and same with economics. And again, as we talked about the last episode we had, stimulus is coming off as well. So I think this inflation story, this is maybe a low probability event, but 6 months from now, it's going to be sort of making its way out. And then the response to that, you'll be central banks, they'll start, putting money back into the system again. Which sort of, one thing that's great about the Loonie Hour, I don't think it's that loony. We always make sense because everything gets reconciled.
Oh my God.
So, well, that's true. But when we say, central banks might only get 2 or 3 rate hikes in, they get stopped out. And this is what we're talking about here. because we do get that. Oh, by the way, I haven't told a story yet. The whole
Well, I
episode.
was gonna say we've had a few people commenting like, you guys always seem to agree with each other. We need to bring on an opposing guest. And I just was saying that Keith's kind of view on market movements here versus Rich's, I think is contradictory or in opposition of each other. So we're gonna find out.
Well, I have another
soon
good
enough.
Here's another good disagreement story with Rich and I. So on Sunday, Rich texts me. So Rich is here in Halifax as well right now, and he texts me, "Hey Keith, can I come over and watch the football game with you?" And I just reply back, I'm like, "No."
Don't disturb Keith when he's watching the 49ers. That's harsh.
It was one of these awkward moments, and I'm just like, "No, you can't. It just doesn't make sense
sacred.
right now." It was something.
Sacred.
It really was.
I mean, Keith,
So,
though, just not to get into it too much, but if inflation's waning, that's hyper positive for demand. Because if that's, I mean, to me, that's a very, very positive thing, because you have a situation where that means that the world is unlocking. That means supply chains are better. That means a situation where consumers, which are not at all over levered in the US and in Europe, have access to relatively cheap credit, strong labor market, strong credit growth. They're wealthier, and the world is unlocking. And that means that they're going to be able to spend more and go places and do things. And all the companies basically that were worried about margin compression are going to be able to hold on to their margins, and earnings are going to be solid in a world where earnings expectations have cratered. You actually have a situation where you're actually setting yourself up for them to beat expectations. So I don't know.
I'm refereeing.
I don't understand. You could be
Keith,
negative
so.
risk assets in that situation.
So it's okay. So listen, I've been through these things a number of times. And all I'll suggest is for someone who says they love risky assets right now because inflation is surging.
But you just said it's going to come down.
Yeah, but then you say you also love risky assets because inflation's coming down. By default, you love risky assets all the time. Like there has to be some kind of a market environment. Do you see what I mean, though? Like
you're mischaracterizing what I'm saying, because what I'm saying is,
I know what's happening. You want to come to my house to watch football.
I do, but I understand I'm banned. I'm banned because I think my point simply is that I think that inflation is naturally going to come off, which I know while you were trading, that's what I was saying. I was saying that there's like a base effect happening. And I think that that's important, A, because I think inflation expectations are very, very high for consumers. But B, because there's like specific tailwinds, and what you need is a situation where consumers continue, the labor market stays hot, people continue to consume. I mean, the fact that the rate of change of growth is coming off is fine. But the key thing for me is, what are the expectations on earnings? And the expectations, if you look at the IBIS estimates, if you look at, forward price earnings ratios for key sectors, they're already way, way, way down. And so you have a situation where you actually have a setup where if the world does unlock and you do get, falling PPIs and you do get a relaxation of lockdowns and zero COVID policy in China ends, and you do get a relaxation in freight costs, which are to me very sensible assumptions. Yes, growth year on year will fall, because obviously you can't go from 0 to 100 and you maintain that pace, but you don't go necessarily into a recession. And I think that's an important driver for earnings and risk assets.
Let's do this. The wager is a fine bottle of wine.
Duro.
That you get to
nice
enjoy.
Bottle of Duro wine.
I brought one for you.
I know. I can't. You won't even come over and enjoy it. I don't understand that.
Winner gets to enjoy a fine bottle at Keith's house.
Not on Sunday.
You know what? We need to do a live Loonie Hour maybe at some point. Yeah. Instead of saying that this episode has been recorded before a live studio audience, we have the soundtrack put in. But one thing
Okay.
just to add though, is sometimes this gets lost in translation. So our average portfolios, we're at 50% in equities, by the way. So, I don't want, I'm not trying to get the message out there that we have no money in the stock market. That's not true at all. And, we're also like, we're never at 100% either. We just think we're living in a world of extremes right now. And like sort of that boat analogy that I talked about earlier, moving from one side to the other. I think that's what we're going to continue to
Keith, I'm
experience.
going to say it while
forward.
we're on the show. I don't know if you're able to say it for compliance reasons, but because some people might interpret that and go, that Keith guy, he's only in 50%, equities. Isn't the traditional portfolio 60-40? This guy's underweight equities. I don't know if you're able to explain your guys's.
Yeah, well, we don't really manage in an over or underweight. That's more like for institutional type mandates. If for our clients, we're trying to avoid losses all the time, produce positive returns. But the old traditional 60-40 mix between stocks and bonds, we've sort of altered that. So besides just stocks and bonds, we're using probably 4 other markets as well. And so when you push all of those together, like in a quantitative type world, we want to get markets with different correlations with each other. And, that helps investors sort of ride out some of these, big bumps that are occurring out there. I think that might answer the question somewhat.
Okay, let me, to wrap this show up here, I do want to have a fun wager. You guys pick the fine bottle of whatever you want to wager, and let's do where's the market at year end? Oh, you guys want to measure on what, based on the S&P or what?
Yes, please.
Okay. Whoever's closer to the actual number. So if the S&P is up 8,
okay.
No, it's a fun. If the S&P is up, let's say 8%, and Rich says 14, and Keith says 3, whoever's closer, baby.
Okay.
Let's do this here.
Drum roll.
We need some music. We need some Jeopardy music.
Yeah,
so from the current market, I think the S&P will finish at 5180, which is a 10.52% return from the current.
You bastard! I don't want to do this bet. That's the average S&P 500 return of the last 50 years. That's exactly what I was going to do.
Are you guys kidding me?
However,
Keith, I thought you were
my number.
Keith, I thought you were bearish.
Yeah, so I gave a current market. I reduced it by I think it was a 15-20% correction. And then I think I used a 35% rebound from that. And that's what the number came out with. So I anticipate.
Do you want to know how I got mine?
So I anticipate a correction, and then we have an opportunity. Then we get more stimulus coming back that the market can take off. But that's important though for investors to know that,
this bet has been squandered.
We're getting lots of volatility. It's going to happen, and being able to participate in that kind of a market, that's the key thing here. But that the same number you had, Rich? Was it the same? Like
yeah,
10 points?
Yeah. I just chose the average S&P return for the last 50 years is like roughly like 10% or whatever. So I just went. I don't know. And so there you go. That was so Keith. It's funny how you and we came to the same conclusion from.
The listeners are going to be pissed.
Yeah, I know.
No, but if you're Steve, you're the high school teacher. You're looking at all the workings for this number coming out. I showed my work. I'm going to get some extra credit for this one. Rich looked over my shoulder and saw my answer.
Oh man, that's hilarious. You guys are basically getting, a long story short, to wrap it up, you guys are coming to the same conclusion, maybe just getting there in a slightly different fashion.
Well, great minds think alike.
There you go.
This was fun today, guys. I like this one. This was good.
Yeah.
Better than last week when Steve forgot to record.
Yeah, we nailed it this time. So as always, it's thanks for tuning in. All we ask is that you share this episode with at least one of your friends, family members, etc. Copy, text this link to the podcast. We are building a community here, great, good Canadian community, and all we ask that you share us with one person. and we'll slowly grow this community. So thank you. God bless. We'll see you next week.